Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have Alasdair Macleod with me once again, one of our more frequent guests on this show, and it's always a pleasure having him, Senior Fellow of Gold Money Foundation, and he writes an excellent weekly report. If you really care about your money, if you care about your wealth, and if you understand that gold is really at the heart of, that gold is real money, that it retains its value, and you really want to take care of what you have, I think you owe it to yourself to go to Gold Money and check in on Alasdair. He writes every week, always some great insights, not the kind of stuff you're going to find on the mainstream media, but really something much more substantive. And, they say you get what you pay for. In this case, you actually get something you don't even have to pay for. So make sure to go to goldmoney.com and keep up with Alasdair. Alasdair, thank you so much for joining me again today.
That's my pleasure, and thank you for the introduction, Jay.
Well, it's great to have you. We're really blessed to have you with us because you do provide a lot of insights that I think are very valuable. Today, I'd like to talk to you about an article that you published on March 21st titled Gold, Preparing for the Next Move. You started out by stating that the global economic outlook is deteriorating. And that certainly rings true with what I hear from other guests on this show and what I read and so forth. Daniel DiMartino Booth, for example, a couple of weeks ago suggested the odds are very high that we will be entering a recession this year in the United States. But could you possibly provide some evidence, some anecdotal evidence, at least, that we're heading into something not so pleasant?
Yes, certainly. I think to really understand the potential for a slump, and I'm going to call it a slump, not just a recession, is the coincidence of tariffs and trade protectionism at the top of the credit cycle.
Yeah.
And the last time this happened, Jay, was in 1929. On October the 30th, 1929, Congress passed the basic provisions of the Smoot-Hawley Tariff Act. That month of October saw the market fall 35% from top to bottom.
Yep.
And as we know, there was then a recovery. But I mean, that was an enormous fall. And then there was a sort of consolidation, which lasted for about 6 months. And then the market just went down and down and down. And it fell at a more or less even pace until around about the middle, I think it was June or July of 1932, by which time it had lost nearly 90% of its value. So I really hope that it's not going to happen this time. Nobody could hope that this happens at all.
No, absolutely.
But I think the point I'm trying to make is that when you get the coincidence of the end of the credit cycle, which, as we know, in normal circumstances ends with a credit crisis, when you get that combining with the hit to international trade from a tariff act or trade protectionism, then you have got a lethal cocktail or a potentially lethal cocktail. And coming back to the point you were making about gold, the reason I think this is very important for gold is that if you go back to that 1929 to 1932 period, prices of commodities, agricultural produce and all the rest of it fell very substantially. We're talking about prices halving. And the point about that was that the dollar was tied to gold. You could exchange your dollars for gold. So actually what we were seeing was not prices falling in dollars. We were seeing it fall in gold. And that, I think, is going to happen again today. Because you will find that as, if I'm right and this turns into a slump, then just the sheer sort of fall in prices in real terms will be reflected in a rising purchasing power for gold. As far as the dollar is concerned, it's a very different thing because it's no longer backed by gold. It is completely freed from gold. And consequently, when you get a slump, tax revenue collapses, welfare costs escalate, rocket up. So you get an enormous, uncontrollable budget deficit. How is it going to be paid for? Well, I think it is quite simple. you'll get more QE, you'll get more monetary inflation. Monetary inflation will become the principal way in which all this is paid for. And that will undermine the purchasing power of the dollar. So you have, on the one hand, the reason why in real terms the purchasing power of gold is going to go up. And at the same time, as the purchasing power of the dollar goes down, that will be reflected in a dollar gold rate, which will be very favorable for the gold price.
So so then we were backed by gold. Of course, we saw the gold values go up dramatically with QE, didn't we? And we did. We didn't really have any substantial. We had some consumer price deflation. We had, of course, financial markets initially collapsed, and then the QE came along, and then gold took off to 2011 highs of almost $1,900 or thereabouts. So you see something similar to that happening again. We're going to get only more QE than we ever got before.
Yes.
And so in terms of the dollar-denominated price of gold, or whatever currency you happen to be looking at, to the extent they all engage in QE, which I suspect they will, around the globe, you should be seeing gold prices as measured in these elastic currencies going up dramatically.
Yes, I mean, those are the dynamics of it. But I think there is a big difference between the Lehman crisis and what we're facing. The Lehman crisis, some of us saw it coming, and we wondered why on earth stocks were holding up and all the rest of it.
Just as they are now.
Just as they are now. But the point about the Lehman crisis is that when it hit, it was very sudden. It was a systemic crisis. Mm-hmm. I mean, the whole world was going to fall apart. And I don't know if you remember, but I remember vividly, there were mornings, and it was only about 2 or 3 mornings in the whole of the crisis where I sort of woke up and I thought, my goodness, how are we going to get out of this?
Yes.
And, in other words, when the Fed printed its way out of it, what did we do? We heaved a sigh of relief. Yeah. Now, that is one sort of crisis. The other sort of crisis is one that evolves, and we've got time to think about it. We don't have that feeling of relief. When you find that the government's finances start going skew-whiff, that doesn't create an immediate crisis for us. We just look at it and we think, oh my goodness, the government is going to have to raise, X trillion dollars, whatever. I thought it was going to be less than that 3 weeks ago, but it's getting worse. We're not going to be seeing the banks go bust. Certainly, if I can concentrate in America at the moment, the banks, if you like, are not in the situation where they were at the time of the Lehman crisis. Mm-hmm. So we're not going to be immediately worried about withdrawing our money from the banking system, or, this is a most appalling situation which has suddenly visited upon us. No, I think that the system will appear to be not itself a threat, but the threat is becoming entirely from the monetary side. And at that stage, we'll be looking at things like the gold price, which will be rising. We might even be looking at Bitcoin, which will be rising. And on that basis, we'll begin to sort of think, well, having our money on deposit in the banks is actually not a very good idea. Perhaps we ought to go and buy some gold, buy some Bitcoin, or buy something to get out of money. We can't go to the bank and take our money from the bank, withdraw it in cash, because the banks won't let you do it. Yes. So what do? We've just got to say to ourselves, well, the only way I can get my money out of the bank is basically to buy something with it and give the problem to someone else. Mm-hmm. So you've then got an interesting situation, because if we all begin to feel this at the same time, then, the person who I'm going to go and buy something from in order to get rid of my bank deposit is going to have a similar view. I don't want to sell this too cheaply because I don't really want money, except perhaps at a far higher price for what I'm selling. So what you could find is, instead of there being, if you like, a sort of a sudden banking come property crisis visited upon us, you could suddenly find that the purchasing power of paper currencies is sliding. The other way in which this could also happen is, of course, and this might indeed trigger it in a sense, is foreigners selling dollars. The foreigners, I was working this out for an article which is going to be published later this week, but the foreigners have got roughly 25 trillion dollars of cash, dollar cash, and dollar investments. And that includes equities as well as US treasuries and other bonds. Now, that is over 100%. It's about 120% of US GDP. Wow. Is owned by foreigners in dollars. This idea that the foreigners don't have any dollars and they need it is a myth. Their problem is not only have they got dollars, but suddenly with the world coming to some sort of trading halt, they find they've got too many dollars. Because the whole reason for holding dollars is you expect growth, if you like, in your sales to America, your purchases of raw materials and all the rest of it. Now that's gone out of the window, going out of the window, you just got too many dollars. So what do? If you're a foreigner, you sell it. And there's a very big impact on America because, okay, we may be talking a marginal story in some senses, but the US government has been funding itself basically out of dollars recycled from the trade deficit. Yeah. So, now that, instead of the foreigners buying US treasuries, they start selling them. This means that you guys in America are going to have to step up the plate and fund your own government. And I don't know that you're going to be quite ready to do that to the extent, particularly when that deficit is increasing at a rapid rate. So you can see that there are all sorts of problems coming. They're very different from the Lehman crisis, but they are very, very similar in many respects, I'm sorry to say, to what happened in 1929 and 32, with one key difference, and that is instead of things being priced in gold through the dollar, they're going to be priced in fiat dollars only.
Well, Alasdair, for years, we in America we've been able to live beyond our means because of as we said, the kindness of strangers, or the countries around the world that were willing to buy dollars, willing and eager to buy dollars. And as you say, out of the trade, we ran these chronic trade deficits that I think were all part of the system that allowed the empire to finance its expansion and do what we've been doing as an empire. And I've always wondered what's going to happen when the day comes when the foreigners are no longer our friends, when they decide they're no longer going to continue buying treasuries and buying dollars, which essentially means investing in treasuries and other assets in America. So I guess that day is coming. But you mentioned in your article, the 21st of March, that you're seeing some signs already that some of the foreign countries are pulling out of the dollar, at least with reducing their dollar holdings, I suppose their treasury holdings. Do you have a sense of which countries those might be? China being one of them, perhaps? Russia for sure.
Yes, I think basically, apart from Russia, which has been on a deliberate course of removing dollars. I mean, she doesn't need any dollars. She gets it from selling oil and energy. So she's just getting rid of dollars as she gets them and replacing that with gold. I think that other than that, it's a pretty marginal story as far as the sovereigns are concerned. But if you look at sort of, if you like, commercial entities rather than sovereigns, they have definitely been reducing their interest in the dollar. And if you look at the tick figures over the last 3 or 4 months, we're beginning to see net outflows for the first time, and fairly consistently so. So it is building up, I think, for a problem sooner rather than later.
Yeah. So you mentioned that even though we start printing money like mad, it's not going to bail us out. It's not going to. The financial markets are in trouble in any event. I mean, we've seen this. Obviously, times are different than 2008, as you just pointed out. But help me understand why the Fed and other central banks can't just simply pump money into the system and keep the markets elevated. For example, they push money into the system, it would push rates down, it would strengthen the bond markets, I would think, at least at the short end of the Treasury curve, right?
Yes, but if they did that, Jay, then I think what would happen quite simply is that the dollar would start falling. To my mind, the signal for foreigners to get more aggressive in their selling of the dollar would be once the Fed is moving towards an easier monetary policy. I mean, at the moment, what they've done is they've just said we're stopping tightening. But when they start deliberately easing, and we begin to start thinking, well, next month they may even cut the Fed funds rate, or by the end of this quarter, they might begin to look at QE again. Once that sort of thing begins to happen, I think that the dollar really will begin to fall. And that will be the point, I think, where the outflows will accelerate or are likely to accelerate. Yeah.
Right. Yeah. And certainly, if investors start realizing that the currency they're living their lives in is starting to lose value, then those stock prices that have such high numbers attached to them might not mean very much, huh?
Well, I think that's right, because what then happens is that you find the analysts start looking at earnings expectations, revising them downwards, looking at companies which have debt which they can't finance on lower sales. I mean, you're going to start finding that all those malinvestments begin to get exposed. You don't need to get rising interest rates really for that to happen. All you need is for the music to slow down and stop, and then suddenly there are an awful lot of people in trouble.
I think you just sort of answered a question a few minutes ago. Most people say, in Americans at least, they say they cannot comprehend the notion that gold would become money again. And I think that you just sort of explained how that might evolve. Gold and other tangibles people would feel the necessity of going to them. They can't pull their money out of the bank. The banks won't allow it. So what are they going to do? They're going to have to take the money. They're going to have to take their demand deposit accounts and through credit cards or whatever facilities are available, get their wealth out of the bank that way by buying things, right?
Yes, yes. I think. Yeah. Sorry, Ray. Sorry, Jay. Yes. No, you're absolutely right. That I think is likely to happen. Now, I think one of the things which we must bear in mind is that it is virtually impossible, as I see it, for the American economy to go on to a gold standard, to get away, if you like, from the problems of a falling currency. Now, this contrasts very strongly with China and Russia. Russia, as we have seen, has already made very substantial moves in the direction of gold. China is keeping her powder dry. Both nations have a lot to lose from a Western economic slump. But having said that, they are in a better position than almost anyone else. There is going to come a point, I think, where countries like China and Russia, where people are borrowing in yuan and rubles are concerned, they will want to crystallize the borrowing rate by making the yen and the ruble tied to gold. Then what happens is that the interest rates in those currencies will effectively adopt the interest rates typical of those paid by a borrower and received by a saver in gold. So, I mean, obviously there will be a spread on that. But having said that, that is a lot better than, let us say, the situation in which America will find herself, where the 10-year Treasury is yielding 10%. The government is finding that it can't fund unless it jacks up the interest rate. Right. And the sense of crisis develops even further because you get into a situation where if the US government can't borrow at 10%, then we certainly wouldn't lend it money at 12% because the numbers just look so much worse. Do you see what I mean? It's almost like a Greek situation developing. And I think that's a very real danger that we'll have from a slump, principally because America can't get away from the fact at the end of the day that the market will impose interest rates on it. It will impose interest rates on it in the light of its currency, the security of its currency. And if that is sliding, then the compensation for risking money in a 10-year Treasury or a 30-year Treasury or whatever is going to be very high.
So there will be price discovery for capital eventually. It has to happen, as you just explained. It sounds to me like the one that Russia and China are putting together, the monetary structure they're putting together, is allowing for a much more manageable price discovery. And we've dug ourselves into such a hole now that it's going to be god-awful when that day comes and when the markets demand finally equilibrium, right?
I think that's a fair comment. The EU is in, I think, a far worse position.
We only have about 30 seconds here, Alasdair, so if you can explain that in 30 seconds.
All right. Well, you've got the EU, in spite of all the money it has been throwing at its economy, is basically collapsing. And I think that when you've got the big German banks in desperate trouble and the Italian banks and all the rest of it, I mean, you can just work it out how horrid it is likely to be. So I wouldn't say the euro is going to go up against the dollar. Both of them are in a race to the bottom.
Yeah. All right, we'll have to leave it go at that, but I would like to tell my listeners, go to Gold Money, read this article by Alasdair, Gold Preparing for the Next Move, and there's a chart that I would like you to look at as well on page 5 that shows gold relative, in relative terms over time, and using the metric that Alasdair put together here, that is a sum of, it has to do with the money supply as well as new gold that's being mined and so forth. We're looking at a gold price, Alasdair, if I understand this, that is as low as almost any time we've seen using those metrics.
That's correct. It goes back to the collapse of the gold pool in the mid to late 1960s. And as a matter of interest for your listeners, that was the last time the dollar had the crisis of the proportion that I'm now expecting.